The Chicago Business Barometer declined 5.7 points to 48.7 in September, as production growth collapsed and new orders fell sharply. The drop in the barometer took it below 50, into contraction for the fifth time this year, accompanying downgrades to global economic growth and intense volatility in the financial markets, which slowed activity in some industries. The latest decline followed 2 months of moderate expansion, and while growth in the third quarter actually accelerated a little from Q2, the speed of September's descent is a source of concern. Time will tell if these downward pressures will continue in the coming months, or whether, as on previous occasions this year, activity will bounce back. However, given the Fed's concern about the impact of global economic developments on inflation and activity, future releases warrant close attention. Indeed, the September survey saw an increase in deflationary pressures, with the global hit to crude oil and other commodity prices continuing to come through strongly. Prices paid fell further to the lowest since July 2009 and suggests that official producer price inflation will remain in negative territory for some time yet. In a special question asked to the survey panel in September, just under 30% said China's economic woes had a greater impact on them than the problems faced by the European Union. A little under 20% cited the EU as having a greater impact, and nearly 30% of the panel said that neither of them had significantly affected their business. 3 of the 5 components of the barometer were in contraction in September, with only employment and supplier deliveries above the 50 neutral level. Production led the decline, with a sharp double-digit drop that placed it at the lowest since July 2009. New orders also fell significantly, and both key activity measures are running well below their historical averages. Companies also appeared to be working below capacity, with order backlogs remaining in contraction for the 8th consecutive month. The sharp rise in stock growth seen in August was not repeated, with inventories falling back closer in line with the long-run averages. Risk now is that companies will be left with a glut of finished goods, at least in the short term. In contrast, employment, which tends to lag orders, rose for the 3rd consecutive month, although the majority of companies on our panel said that staffing levels were unchanged. Supplier deliveries remain broadly unchanged, holding above 50 for the 2nd consecutive month.